What happens when a company moves from boardroom scandals to board-certified excellence? This is the story of Fortis Healthcare, one of India's largest integrated hospital and diagnostics platforms, and its complete transformation from a governance-challenged past to a credible, compounding healthcare business. Today, Fortis operates a powerful dual-engine model. 1. Hospitals, the primary revenue driver, contributing around 80% of the company's earnings, with a network of 28 hospitals across metros like Delhi, Mumbai, Chennai, and Bangalore. These hospitals are known for complex, high-margin specialties such as cardiology, oncology, orthopedics, neurology, and transplants. 2. Diagnostics, SRL, an asset-light high-margin growth arm that includes over 400 labs and 2,000+ collection centers across India and select international markets. It contributes 17% of revenue, with operating margins of 25% or more, and is positioned for scalable expansion through franchise and institutional partnerships. Fortis enjoys strong brand recall in urban India, benefits from a non-cyclical demand curve, and now operates under the strategic and governance umbrella of IHH Healthcare, a global healthcare major that acquired control post-2018. The company's business is recession-resistant because healthcare demand doesn't fall in economic downturns, scalable, thanks to a mix of owned and managed hospital models, profitable, with improving operating margins, cash flow, and capital discipline. Fortis is not a turnaround story anymore. It's a mature, risk-conscious compounder with dual growth levers, strong governance, and high visibility. Investor insight: Fortis Healthcare has successfully transitioned from controversy to credibility. It now offers a compelling mix of healthcare stability, diagnostics growth, and strategic reinvestment, all under clean, professional leadership. Key takeaway: Fortis is a high-conviction candidate for long-term investors looking for dependable, compounding exposure to India's growing healthcare sector. Before we invest in any company, we must ask, how does this business actually earn money? And more importantly, is this business simple, scalable, and sustainable? Fortis Healthcare checks all three boxes. It operates through two well-defined verticals. 1. Hospitals, the core revenue driver. Fortis runs 28 hospitals across India and overseas, primarily in high-income metros like Delhi, Mumbai, Chennai, Kolkata, and Bangalore. These hospitals focus on complex, high-value treatments in cardiology, oncology, neurology, orthopedics, gastroenterology, and transplants. Revenue comes from inpatient services, IPD, surgeries, ICU care, admissions, outpatient services, OPD, consultations, health packages, procedures, including radiology, daycare surgery and interventions, insurance and TPA billing, a major revenue stream, especially in urban hospitals. Hospitals are high fixed-cost businesses, but once utilization crosses 60–70%, profitability grows exponentially due to operating leverage. Fixed costs are spread across more patients. 2. Diagnostics, SRL, the margin enhancer. SRL is among India's top 3 diagnostic chains. It operates over 400+ labs, 2,000+ collection centers. With services like blood tests, radiology, genomics, and preventive screenings, diagnostics is an asset-light, high-margin business with OPMs over 25% and is scalable through franchises and B2B hospital partnerships. Together, Fortis's model is integrated. Hospitals plus diagnostics under one brand, cross-selling plus synergy asset smart. CAPEX focused on hospitals, diagnostics follows lighter models urban-centric. Metro presence enables premium pricing and insurance coverage, recession-proof. Healthcare demand remains stable in all economic cycles brand-driven. Fortis enjoys high patient trust and corporate recall in Tier 1 cities. Additionally, Fortis is expanding into Tier 2 cities via franchise and affiliate models, scaling without overextending CAPEX. Investor insight: Fortis's business model is robust and thoughtfully diversified. Its dual-engine structure, high-revenue hospitals and high-margin diagnostics, ensures both stability and scalability. Key takeaway: Fortis earns through a powerful combination of urban hospitals and pan-India diagnostics, This gives it a competitive edge, steady cash flows, and scalable growth potential, all underpinned by brand strength. A business can tell stories, but its numbers tell the truth. To understand Fortis Healthcare's true transformation, we must look at the 10-year financial journey from FY 2016 to FY 2025. Let's start with the basics: revenue growth. In FY 2016, Fortis earned Rs 199 CR in sales. By FY 2025, that number rose to Rs 783 CR. That's a 10-year CAGR of 6.9% growth, was flat between FY 2017, FY 2021, held back by regulatory price caps, asset restructuring, and the COVID-19 pandemic. But from FY 2022 onwards, growth picked up sharply, with sales CAGR 10% in the last 3 years. Operating profit, EBIT, and margins. In FY 2016, operating profit was just Rs 92 CR, with an OPM of 2%. By FY 2025, EBIT reached Rs 588 CR, and margins climbed to 20%. This margin expansion came from exiting loss-making assets, improved capacity utilization, cost controls, and better payer mix, and integration under Fortis Healthcare post-2018. Net profit, PAT stability. Fortis reported losses in FY 18, FY 19, and FY 21 due to legacy promoter issues, restructuring, and COVID. But from FY 2022, PAT stabilized between Rs 550-774 CR. Net profit margin now holds steady around 9–10%. These profits are not one-off gains. They're recurring, backed by operational strength. EBITDA, the cash core. EBITDA rose from Rs 392 CR in FY 16 to Rs 577 CR in FY 25. After depreciation and impairment losses during the cleanup years, EBITDA became the key sign of health. Margins are now in line with top peers, red flags now resolved. Between FY 18 and FY 21, Fortis faced margin shocks, negative PAT, and weak governance. But post the IHH acquisition, these issues were addressed with cleanup, exits, and structure. Investor insight. Fortis's last 10 years tell a story of professional rehabilitation. From near zero margins and losses, it now delivers solid revenue, double-digit operating margins, and reliable PAT. Key takeaway. Fortis Healthcare has undergone a deep financial transformation, evolving from erratic, low-margin performance to a stable, efficient, and profit-generating business. Revenue can be inflated, profits can be tweaked, but cash flow, that's the truth. Cash is the real profit of the business. So let's ask, is Fortis truly generating cash from its operations? And is it deploying that cash wisely? The answer, mostly yes, and increasingly so. Cash flow from operations, CFO. In FY 2016, Fortis generated Rs 195 CR in CFO. By FY 2025, that number grew to Rs 424 CR. Over 10 years, cumulative CFO is a strong Rs 344 CR. This growth reflects higher and stable EBITDA, better control over working capital, and improved collections from insurance and TPA payers. Most importantly, CFO now tracks PAT, a clear sign of quality earnings. CAPEX and free cash flow, FCF. Fortis made major CAPEX investments in FY 17 and FY 19, Rs 2,000 plus CR and Rs 3,900 plus CR respectively. These were used for upgrades, acquisitions, and hospital expansions. In recent years, CAPEX has moderated to Rc 800, 1,100 CR. Free cash flow, FCF, has been volatile, negative in 6 out of 10 years, but turned healthy in FY 25 with Rs 624 CR in positive FCF. This means Fortis is now generating surplus cash after all investments, a key milestone in maturity. ROCE, ROE, and value creation. ROE has improved to 9% in FY 25. ROTE stabilized around 8–10%, not ideal, but improving. Compared to its cost of capital, approximately 11–12%, Fortis is still catching up, but the trajectory is upward. Now here's the real kicker. For every Rs 1 retained as profit, Fortis created Rs 37.3 in market cap. That's a powerful sign of capital efficiency and market trust. What this tells us: Fortis is now generating real recurring cash profits. While it's still capex heavy, much of that investment is strategic and growth focused, not wasteful. Liquidity is strong, debt is under control, and the business is funding itself through internal accruals more than ever before. Investor insight. Cash flow analysis confirms the turnaround. Fortis now generates real profits, is reinvesting with discipline, and is creating long-term value from every rupee it retains. Key takeaway: Fortis's cash engine is now firing. With rising FCF and strong CFO, this is no longer a turnaround. It's a business ready to compound from within. Growth is exciting, but smart investors ask, how is that growth funded? Did the company grow using retained profits? Or did it borrow heavily or dilute shareholders to expand? That's where self-sustainable growth rate, or SSGR, comes in. SSGR = Rho x 1 dividend payout ratio. It tells us how fast a company can grow its net worth using only internal funds without relying on debt or fresh equity. Fortis's SSGR journey, FY 2019 to FY 2025, FY 19, -9% FY 20, -10% FY 21, -5% FY 22, -2% FY 23, 0% FY 24, 2% FY 25, 2%. What does this mean? For the first 4 years, SSGR was negative, due to weak or negative PAT, low ROE, losses from past governance and restructuring, but from FY 23 onwards, Fortis finally turned the corner. With stable profits and an ROE of 8-9%, SSGR turned marginally positive at 2%. However, that's still not enough to fund meaningful growth internally. At this rate, Fortis can only grow its equity base by 2% a year unless it raises capital from other sources. Why is SSGR so low? Despite rising PAT, ROE remains modest. Fortis retains most profits, payout ratio approximately 10-13%, but return on those retained funds is not yet high. Being an asset-heavy business, capital efficiency is still catching up. In simple terms, Fortis is no longer burning cash, but it's also not self-funding its expansion yet. Investor insight. SSGR shows that while Fortis is now profit-generating, it still requires outside capital or asset-light strategies to grow meaningfully. The engine has started, but it's not running full speed on its own. Key takeaway: Fortis is not yet a self-fueled compounder. For now, it must supplement growth through borrowings, internal accruals, or low-risk partnerships, not just retained earnings. In a hospital business, it's not just about size. It's about how efficiently you run what you already own. That's where operational efficiency comes in, and Fortis has shown remarkable progress over the last decade. Let's start with the numbers. In FY 2016, Fortis had an operating profit margin, OPM, of just 2%. By FY 2025, OPM has grown to 20%, a tenfold expansion. Net profit margin, NPM, also climbed to 10%. After being negative for years. These gains aren't just because of revenue growth. They're the result of better execution, leaner operations, and a more profitable patient mix. Let's look at hospital bed utilization. Bed occupancy, 64% in FY 25, up from 60% earlier, but still below optimal levels of 70-75%. ARPOB, RS2, 23 lakh month, rising steadily due to premium care and urban pricing. ALOS, average length of stay, 3.3 days, a reduction from earlier years, showing faster patient turnaround. Lower ALOS means more patients served per bed, a major efficiency gain. Fortis's fixed asset turnover rose from 0.46x FY21 to 0.77x in FY25. That means it's generating 77 pays of revenue for every RS1 invested in assets, up significantly from its restructuring years. Employee costs, down from 27% of revenue in FY17 to just 15% in FY25. Scandal and other expenses, consolidated under other expenses in FY25, now at 41%, but likely due to reclassification, not inefficiency. This shows Fortis has optimized staffing, outsourced non-core functions, and centralized key operations. Fortis has transformed from an inefficient operator into a highly streamlined healthcare engine. Margins are now structurally higher, and every rupee of infrastructure is being used better than before. Fortis's operations are no longer bloated. They're efficient, scalable, and margin-focused. This is the backbone of future profitability. For long-term investors, who runs the business is just as important as how much profit it makes. Fortis Healthcare's story is especially powerful because it's a rare case of governance resurrection. Let's start with the past. In the mid-2010s, Fortis was promoted by the Singh brothers, who were later accused of siphoning off funds, misusing related party deals, and compromising board independence. The damage was real. Fortis faced reputational loss, regulatory scrutiny, and investor distrust. In 2018, a game-changing event occurred. IAH Healthcare, a global hospital group based in Malaysia, acquired 31.1% control of Fortis, bringing international governance standards and institutional discipline. This was not just a promoter switch, it was a cultural overhaul. A new independent board was appointed, with directors from healthcare, finance, and legal backgrounds. The Audit and Risk Committee was empowered to review all related party transactions and internal controls. Promoter pledge =0%, indicating zero financial distress, institutional holding -57%, with FIIs and DIIs trusting Fortis's turnaround. CEO and MD roles were filled by experienced professionals, not legacy insiders. Capital allocation became conservative. No reckless M&A, no equity dilution, capex funded internally, no governance. Red flags have re-emerged since FY 2020. Consistent dividend payouts since FY 23. Corporate disclosures and audit reports now meet global standards. Promoter stake is intact, but professionalized and accountable. Fortis is no longer a promoter-led risk story. It is now governed by global healthcare experts, backed by institutions, and run with transparency and accountability. Fortis has transformed its governance DNA, from past frauds to present-day stewardship. For investors, this is a green flag backed by 4 years of clean execution. Great businesses aren't just about how much they earn, but how wisely they use their money. In this scene, we look at how Fortis manages capital, from debt and dividends to capex and reinvestment, to answer a key investor question. Is Fortis a financially responsible company? Over the past 10 years, Fortis has maintained a healthy debt-to-equity ratio between 0.2x and 0.5x, well within safe limits. In FY 23, Fortis had brought debt down to Rs 926 crore, its lowest in a decade. In FY 25, debt increased to Rs 475 crore, but this was strategic, not distress-driven. The spike was to fund the acquisition of a 31.5% stake in Agilus Diagnostics, a growth move in the diagnostics space. This wasn't reckless borrowing, it was a calculated expansion. Fortis's interest coverage ratio improved from 0x in FY 16 to a robust 7x in FY 25. This means it earns 7 times more than its interest costs, a sign of strong financial resilience. In fact, rating agency CRISIL reaffirmed Fortis's AA stable rating, citing solid EBITDA, controlled debt, and strong operating cash flows. Fortis's capital priorities are clear. Internal accruals fund most capex, no major equity dilution in recent years, dividend introduced in FY 23, modest but consistent, preference for brownfield expansion over risky greenfield bets. The FY 25 capex plan of Rs 800 crore is fully covered by internal cash flows, a sign of maturity. Fortis balances growth and safety. It avoids aggressive financial engineering, maintains liquidity, and uses debt to build, not bail out. This reflects high-quality capital allocation behavior. Fortis is financially prudent. It grows through internal strength, keeps leverage in check, and prioritizes capital efficiency, not just expansion. No investment is complete without looking at what could go wrong. Fortis Healthcare, while fundamentally strong today, still carries a few strategic risks and red flags that every long-term investor must monitor. Let's break them down, not as deal breakers, but as areas requiring attention. Fortis operates in one of the most heavily regulated sectors in India. It is affected by the Clinical Establishments Act, which governs hospital infrastructure and staffing NPPA price caps, especially on life-saving devices like cardiac stents and orthopedic implants, and tighter controls on ethical marketing and referral fees. These can directly reduce pricing power, especially in high-margin specialties. Regulatory tightening may not stop growth, but it can compress margins. SRL is among the top 3 diagnostics chains in India, yet it lags behind Dr. Lal Pathlabs and Metropolis in brand visibility and B2C scale. Despite 420-plus labs and 2,000-plus collection centers, SRL's revenue contribution has stagnated around 17%. SRL is now repositioning toward B2B and institutional channels, but execution speed remains a risk. Bed occupancy sits at 64%, below the 70-75% sweet spot for full operating leverage. While ARPOB and ALOS have improved, low occupancy limits margin expansion. This may delay ROCE improvement, especially in high capex hospital assets. Though governance has improved post-IHH, the Singh brothers era still lingers in investor memory. Some conservative institutions may continue to avoid Fortis, not due to fundamentals, but because of past associations. Reputation takes time to heal. These risks are structural and strategic, not existential. None threaten Fortis's survival, but they could cap upside or slow compounding if not addressed proactively. Fortis is fundamentally sound, but not risk-free. Regulation, underscale diagnostics, and legacy perceptions are key watchpoints for long-term investors. We've covered Fortis Healthcare in detail, from financials and cash flows to governance and strategy. Now it's time to run it through a 15-point investor checklist based on Dr. Vijay Malik's long-term investment framework. Let's assess whether Fortis truly qualifies as a buy-and-hold compounding candidate. 1. Business understanding. Pass simple, recession-proof model with dual verticals, hospitals plus diagnostics. Easy to understand, backed by structural demand. 2. Revenue consistency. Pass moderate long-term growth with strong recovery post-FY22. Recent years show double-digit momentum. 3. Profitability track record. Watch losses from FY18-FY21 due to legacy issues. Profitable since FY22 but long-term PAT is uneven. 4. Operating margins 15%. Past current OPM stands at 20%. Clear margin expansion from better utilization and cost control. 5. Positive CFO, PAT. Past cumulative CFO R6 344 crore. Cumulative PAT Rs1 597 SAR shows quality earnings. 6. Free cash flow, FCF. Watch FCF is volatile, only positive in 4 out of 10 years. FY25 shows healthy Rs624 CR in FCF. 7. ROS, cost of capital. Watch ROS improved to -9% but still below ideal 15%. Trend is upward post-cleanup. 8. Self-sustainable growth rate, SSGR. Fail current SSGR is just 2%, not enough to self-fund growth. Needs support from cash or debt. 9. Governance and promoter quality. Pass post-IHH. Governance is fully professionalized. Independent board, no pledge, clean audits. 10. Capital allocation. Pass brownfield capex, no dilution, stable dividend, strategic M&A, very capital disciplined. 11. Debt levels. Pass DE ratio stable at 0.3x. Recent debt is strategic. Interest coverage, 7x. Strong credit rating. 12. Regulatory sensitivity. Watch NPPA price caps and clinical laws are a risk. Manageable, but persistent. 13. Diagnostic scale. Watch SRL has reach, but lags in consumer recall. Institutional pivot is smart, but needs execution. 14. Occupancy and utilization. Watch at 64%. Bed occupancy is improving, but below optimal levels. 15. Valuation versus growth. Watch PE approximately 68 in FY25, elevated. Must be justified by consistent earnings compounding ahead. Final tally. Pass 8, watch 6, fail. 1 Fortis scores well across most core metrics, especially business model, governance, cash flows, and capital discipline. The watch areas reflect a business still maturing, not malfunctioning. Fortis passes as a structurally strong long-term opportunity, with some growing pains. It's not perfect, but it's investable and improving where it matters. So now the final question. Should you invest in Fortis Healthcare? Let's break this down with a balanced view. The bull case, the bear case, and the base case. Bull case. High conviction, high growth. If Fortis executes well, here's what could happen. Hospital occupancy rises to 70-75%, unlocking operating leverage. Diagnostics expands through B2B channels and M&A, increasing its revenue share to 25%. ROCE improves beyond 12-13%. SSGR becomes positive enough to support organic growth. Regulatory risks remain neutral, and premium pricing in Tier 1 markets continues. This scenario could deliver 15-18% annualized returns over 5-7 years as earnings compound and valuations stay strong. Bear case, execution falters, risks materialize. If things go wrong, occupancy remains below 65%, limiting hospital margin expansion. SRL continues to underperform peers. Regulatory caps tighten, pressuring RPOB, and profits. Interest rates rise, impacting cost of capital. Fortis fails to generate sustainable free cash flow. In this case, annualized returns may drop below 6-8%, and the stock could underperform the Nifty Healthcare Index. Base case, balanced growth with stability. Most likely, Fortis will grow revenues at 10-12% CAGR, maintain 20% plus OPM, 10% PAT margin, improve ROCE slowly while maintaining capital discipline, generate moderate FCF, and use a mix of internal accruals and smart debt for expansion. This could result in 12-14% annualized returns, with lower risk than most healthcare peers, making Fortis suitable for core portfolio allocation. Fortis is not a hyper-growth rocket. It's a stable, professionally run, capital-efficient compounder with dual growth levers and improving fundamentals. Fortis Healthcare is investable, not because it's flashy, but because it's solid. Ideal for long-term investors seeking structural growth, risk control, and real cash-backed earnings. Before we deliver the final verdict, let's take one last strategic pause. How do you objectively evaluate a business across financial, operational, and capital strength? We do it through a 7-factor key analysis framework, a diagnostic tool for long-term investors. Let's examine how Fortis Healthcare scores on each of these critical pillars. Sales growth? Watch. Over 10 years, revenue CAGR stands at 6.9%. However, growth post-FY22 has improved to 10%. Diagnostics contribution remains modest, limiting total top-line expansion. Verdict: moderate sales growth, improving, but not yet stellar. Operating margin trend: strong. OPM rose from 2% in FY16 to 20% in FY25. Clear structural shift driven by better utilization, cost controls, and patient mix. Verdict: strong margin trend with sustainability built in. PAT quality: watch. PAT turned consistently positive only from FY22, volatile in prior years due to exceptional items and restructuring. Verdict: recent PAT is clean, but full track record is mixed. Cash flow quality: strong. CFO over 10 years =R6 344 CR versus PAT of RS1 597 CR. CFO consistently tracks operating earnings. Verdict: excellent cash flow conversion. Earnings are real. Debt management: strong. Debt to equity =0.3x. Interest coverage 7x. Strategic borrowing for diagnostics expansion. Verdict: conservative and well-managed debt strategy. Return on capital: watch. ROCE has improved from 5% to 9%. Still below cost of capital, approximately 11-12%, but trending up. Verdict: needs further improvement to unlock long-term compounding. Valuation versus growth match: watch. Valuation is rich, PE approximately 68 in FY25. Needs consistent PAT compounding to justify premium. Verdict: valuation demands flawless execution, currently balanced. Fortis shows strength in profitability, capital discipline, and cash flow quality, but is still evolving on returns and valuation alignment. A classic case of a maturing compounder. Fortis passes the key factor test, not flawlessly but firmly. It stands on strong financial legs with room to improve, which is exactly what makes it a long-term opportunity. Before we wrap, a quick but important note. Disclaimer: this video is not investment advice. It is an educational breakdown based on publicly available data and the researcher's independent analysis. Please consult a certified financial advisor before making any investment decisions. Your capital is always at risk, especially in equity markets. Now, your call to action. You've seen the business model, the cash flows, the governance transformation. Fortis Healthcare is no longer a recovery story. It's a serious institutional-grade opportunity. But no one knows your goals better than you do. So revisit the facts, watch the numbers, track the risks, and if this thesis fits your strategy, Fortis could earn its place in your portfolio. If you found value in this deep dive, share it with someone who invests like you, because better investing begins with better understanding. Until next time, stay rational, stay informed.